The number's weaker than expected. We were expecting 200,000 jobs. Stephanie Pombo, your reaction?
Well, if you think these numbers look weak now, give it a minute. My view is when we get into the first quarter, you're going to see a dramatic slowdown in all the economic data for a variety of reasons. Obviously, seasonally, first quarter tends to be weak, but you're also going to lose a lot of tailwinds that are currently supporting economic growth, from post-hurricane rebuilding to J-curve effects associated with the tariffs. In other words, companies import now goods that they expected were going to become more expensive on the threatened tariffs on Jan 1. So that has been silently boosting growth. And then, of course, behind the scenes, while the Fed's been winding down its balance sheet, the ECB and the BOJ have been continuing to expand. That all ends in the early part of next year. So I think, we got to acclimate ourselves to some weaker numbers along the lines of what we're seeing in terms of the headline report today, because come first quarter, these numbers are going to get softer still. And I think, that's why the Fed is starting to kind of lay the groundwork for pausing its rate hikes.
And do you think that's the case, Stephanie, because rate hikes are slowing things down? Is it just the length of this recovery? What specifically has you thinking things are going to slow down so much in the coming year?
Well, I think the rate hikes have been an ongoing drag that was masked by the stimulus from the tax cuts this year. So I think, in 2018, the fiscal stimulus story stole the show. 2019, I think monetary restraint is going to be the story. I mean, we have to remember that starting in December 2015, the Fed started raising rates. And for the consumer, they noticed that. They felt the tightening. Credit card rates went up. Personal loan rates went up. So they've been experiencing the Fed tightening. The corporate bond market, the corporate sector, didn't have any effect from Fed tightening until just recently. And now they're really starting to feel it. You've seen an increase in yields and spreads in the corporate market that's starting to increase interest expense there. But also behind the scenes, the wind down of the Fed's balance sheet has been draining reserves from the banking system, slowing credit creation in general, and credit is the fuel in the tank for this economy. So it's, been a tailwind a headwind behind the scenes that no one noticed because the tax cuts for a period there overwhelmed it. But coming into January of next year, obviously the tax cut effect falls away.
Well, the administration would push back on that, John. The administration will say, you know what, this has a long runway, the tax cut benefits, but we'll see. What do you think?
Well, I mean, a lot of people are expecting the economy to slow in 2019, in part not only because the impetus of tax cuts are waning, but also some of the spending and impetus. As far as today's report, I would call it a good news, bad news report. Let's not forget, a 3.7% unemployment rate is still exceptionally low. That's very good news for the economy. The 155,000 payroll number is a little on the soft side. It's not extremely soft. It's not screaming massive slowdown or recession. It is soft enough for the Fed to continue with this idea that maybe they're going to slow down the pace of rate increases. But, the soft payroll number suggests that the slowdown that a lot of people have been talking about might be staring us in the face.
Charles Payne, what do you think?
I got to agree with some of the things Stephanie and Dagan brought up. Yesterday, that report from the New York Fed, I think, was overlooked by a lot of people with respect to credit, the credit survey. Loan applications were down 1.2 percentage points. Loan rejection rates were down 5.5 percentage points. And lenders closing out credit cards at 7.5% from 5.7% a year ago, from 4% a year earlier than that. And if you dig even deeper, the mortgage stuff is really scary, scary stuff. So the Fed sees this. Also in that speech that Jerome Powell gave last night goes to what Dagan said about Jay Powell understanding that this has been an uneven recovery. His closing remarks, he said, while the economy is strong overall, we recognize some communities have yet to feel the full benefits of the ongoing expansion. So I don't think this 3.1% wage increase is going to be the thing that gets them to move. And I think he understands if they do move, the very people he's citing right in this speech last night won't get any of the benefits that he seems to want them to have.
Yeah, our hourly earnings up 0.2% in this report. Guy Benson, your reaction?
Yeah, so you've got wages up. That's a good sign. Unemployment steady. 3.7 is a very good, stable number. The workforce participation rate also unchanged. A slight miss in terms of jobs created.
Yeah.
But I think that you're exactly right, John, to say there's good news, bad news. I'm looking now, Dow Jones, their lead about this jobs report is U.S. employers slowed their pace of hiring in November, but wage growth matched the highest rate in nearly a decade, and unemployment held at a very low level. So there's something for everyone, I think.
You want it just down the middle. This is what this seems like. You said earlier we want to down the middle when it comes to the Fed.
This is close to the middle of the fairway, a little on the soft side, but it's important to remember we don't need a lot of job growth to keep that unemployment rate steady at 3.7%, and that's a great unemployment rate for American workers. It means there are a lot of jobs out there for people to get. So a slowing in payroll growth isn't such bad news as long as it stays around this 150,000 range. If it starts going below 100,000, then we get worried.
Joni Corney, where are the jobs right now?
You know, the jobs right now are certainly in engineering. Healthcare sector continues to do well. But I think the interesting dynamic here with this report is that the wage growth did come out stronger, you know, being at 3.1%. And I actually think due to unemployment being so low, we could continue to see wages continue to move all the way through 2019 because employers still have a strong demand in many sectors, in many industries. They're really looking for that skilled talent. And they're being forced to do two things, Maria. They're being forced to pay people more, and they're also being forced to offer training and skills ongoing to their employees to get them to the level of where they need them to be. And that's at all levels of the organization.
Yeah.
So I actually think it is a good report. We'll probably continue to see more of this, but I really believe that wages are going to continue to improve through 2019, even if we see some other economic indicators slow down.
Yeah, and therein lies the worry, right, Dagan? Because, yes, you've got a number that's pretty good as far as markets are concerned. You're seeing this market come all the way back here after being down sharply. But what Joni's talking about in terms of these companies being forced to pay people more, that's got to hit profit margins. That's got to mean slowdown. Market just went positive, up 7 points on the Dow Jones Industrial Average after being down 100 points earlier. Dagan.
In addition to the rising input costs from a number of areas, including the tariffs, I would add that. That said, we still had manufacturing payrolls up by 27,000. That was above expectations of just 20,000. That was one spot to note. Also, if you look at construction jobs, of all the talk we heard literally for years about there not being enough housing supply on the market, construction jobs were only up 5,000. There are obviously weather factors that go into construction. But you've seen, because of the higher interest rates, because of higher mortgage rates, throughout the year, a weakening in the housing market. Home prices, home price gains are slowing. Existing home sales have declined for 8 straight months. So that's where you want to look at these individual sectors for signs of weakness. And I think that 5,000 jobs added in construction might be one of those signs of a little softness in the economy.